Hey everyone! Today, we're going to break down a financial plan that tries to do two really important things at once. Protect your family and, at the same time, build up your savings. It's called LIC's Bima Jyoti. The name itself kind of hints that it's supposed to be a guiding light for your money. So let's see if it lives up to that. I mean, this is the classic financial dilemma, right? How do you plan for the future, retirement, your kids' college, while also making sure that if something happens to you today, your family is going to be okay? That's the exact puzzle this plan is trying to solve. So here's our roadmap for this explainer. We'll start with what the plan is all about. Then we'll cover who can get it and what the benefits are. After that, we'll look at how you can beef it up a bit, touch on some super important details you need to know, and finally, help you figure out if this is really the right move for you. Okay, let's dive right in. First things first, what exactly is the Bima Jyoti plan when you strip away all the fancy language? Whoa, okay, that is a whole lot of insurance speak, so let's translate that into plain English. The two words you really need to focus on here are non-participating and non-linked. All this means is that your returns are not gambling on the ups and downs of the stock market. What you're promised on day one is exactly what you get. It's all about stability. All right, so it's a stable, guaranteed plan. But who's it for? Who can actually sign up for this? Let's check out the entry requirements. A couple of things really stand out here. First, look at that age range. You can get this for a newborn who's just 30 days old, all the way up to someone who's 60. And here's a really cool feature. You can choose a 15 or 20-year term, but you actually stop paying premiums 5 years early. So you pay for less time than you're covered for. The minimum amount you can insure is $1,25,000, and technically there's no upper limit, but you'll need approval for really large amounts. Okay, this is the section everybody really cares about. What's the bottom line? What's the payout for you or your family? Let's break down the two main outcomes. So you can think of this plan having two major paths. Path one, you live through the whole term and you get a nice payout at the end. Path two, if something unfortunate happens during the term, your family gets a financial cushion. Let's look at exactly how much we're talking about for each path. First, let's talk about the maturity benefit. It's super simple. You make it to the end of the policy term, and you get back the full amount you were insured for, the basic sum assured, plus these things called guaranteed additions that have been piling up every single year. We'll talk about those additions in a second. Now, for the protection side of things, if the policyholder passes away, their family gets what's called the sum assured on death, plus all those guaranteed additions. Now, this is really important. The sum assured on death is always the higher of two calculations, either 125% of your basic cover or 7 times what you pay in premiums each year. This is designed to make sure your family gets a truly meaningful amount of money.
And this is the engine that drives the growth in your plan. Remember those guaranteed additions I keep mentioning? Here's how they work. It's incredibly straightforward. For every 1,000 rupees of your basic sum assured, the plan adds a guaranteed 50 rupees at the end of each policy year. Every single year. This is how your savings component steadily grows over time.
Okay, so the core plan is solid. But what if you want to customize it a little? Add some extra layers of security for your specific situation. That's where riders come into play. You can think of these riders as optional upgrades for your policy. For a little extra in your premium, you can add them on to tailor the coverage and make sure it really fits the risks you're most concerned about. So you've got a few options here. There are riders for things like accidental death and disability, which give an extra payout for those specific events. You can add a term assurance rider just to boost your overall life cover. But this last one, the premium waiver rider, man, this one is huge. If you're a parent buying this policy for your child, it means if something happens to you, the policy doesn't just stop. Nope. All future premiums are waived, and the plan continues for your child. It's an amazing feature. All right, we've talked about all the promises and benefits, but what about the real world? What happens if you miss a payment? Or what if you suddenly need cash for an emergency? Let's get into the practical details. So, life happens. Let's say you miss a premium payment. Don't panic. You have a grace period. 30 days for most payment plans, 15 if you pay monthly. If you miss that, your policy lapses and your coverage stops. But, and this is a big but, you have 5 full years to revive the policy just by paying the overdue premiums plus a bit of interest. What if you need money but don't want to cancel the whole policy? Well, that's what the loan feature is for. As soon as you've paid premiums for 1 full year, you can take a loan against the policy's value. The amount you can get is just a percentage of its cash-out value. And yeah, since it's a loan, you do have to pay interest on it, which right now is sitting at 9.5% per year. So, how much can you actually get? Well, if your policy is active and all premiums are paid up, you can borrow up to 80% of its surrender value. If you've stopped paying premiums but the policy is still active with a reduced value, that's called paid up, you can still borrow up to 75%. And finally, what if you just need to walk away from the plan and cash out? You can do that anytime after the first year. The amount you get back will be the higher of two different calculations, either a fixed formula-based value or a special value that the company might declare, which could actually be better for you. Okay, numbers on a page are one thing, but this is where it all clicks. Let's look at a real example. Imagine a 35-year-old gets a 20-year policy for 10 lakh rupees. They'll pay premiums for just 15 years, which adds up to a little under 12 lakhs. But when the policy matures in 20 years, the guaranteed payout is 20 lakh rupees. That's the original 10 lakh plus another 10 lakh in those guaranteed additions we talked about. This really shows you how the savings part of the plan works in practice. So, we've gone through all the features, the benefits, and the nitty-gritty details. That brings us to the final, most important question. How do you know if a plan like Bima Jyoti is the right fit for you? So let's boil it all down. What do you need to remember? Number 1. The returns are guaranteed, no stock market drama. 2. You get two things in one, life insurance and a savings plan. 3. It's simple, what you see is what you get. And 4. You can customize it with riders. So this plan is really for someone who values safety and predictability above all else and wants a solid life cover to go with it. At the end of the day, it all comes back to you. This plan offers one specific path, a path of guarantees and stability. The real question you have to ask yourself is, what are your goals? What are you trying to build? Because figuring out your destination is always the most important first step. Thanks so much for tuning in.